Something unprecedented is happening in global capital markets right now, and most people haven't even noticed it. BlackRock, the largest asset manager on Earth with more than $14 trillion under management, has quietly shifted nearly $2 trillion in market exposure. That is not a typo. $2 trillion. And what makes this so important is not just the size of the move, but the silence around it. No press conferences, no breaking news banners, no loud headlines, just real institutional capital being repositioned behind the scenes in a way that signals exactly where the next wave of global wealth creation is heading. This wasn't some rumor floating around online or a speculative story from financial Twitter. This was an actual structural rotation happening inside the world's most powerful investment machine. And when BlackRock moves capital at this scale, it is never random. It is never emotional. It is calculated, data-driven, and forward-looking. The direction of this shift tells us something most retail investors won't understand until it's already too late. The easy money always gets made before the trend becomes obvious. Once CNBC starts running segments about it, institutions have already positioned and regular investors are left buying at the top. To understand why this matters, you need to understand what BlackRock really is. BlackRock isn't a hedge fund making risky bets. It isn't a celebrity investor guessing about the next hot stock. BlackRock is the infrastructure of global finance. With $14 trillion under management, it controls more capital than the GDP of almost every country on Earth except the United States and China. BlackRock is inside your retirement plan. It is inside pension funds, university endowments, sovereign wealth funds, and virtually every major institution that allocates capital at scale. It owns meaningful stakes in Apple, Microsoft, Amazon, ExxonMobil, JP Morgan, and nearly every company in the S&P 500. When BlackRock moves, it doesn't just react to markets, it shapes them. Larry Fink, BlackRock's CEO, has access to economic intelligence that most people will never see. Teams of analysts track currency flows, demographic trends, geopolitical shifts, and policy changes long before they show up in mainstream headlines. But here's the key point. You don't need access to their internal research. You just need to watch what they do. And what they've done is rotate massive exposure away from the United States and toward international and emerging markets. This doesn't mean America is collapsing tomorrow. It doesn't mean you should panic sell everything or abandon US stocks entirely. What it means is that the center of gravity in global growth is shifting. Capital moves like water. It flows toward the highest return with the least resistance. For more than a decade, that flow overwhelmingly favored US equities. But for the first time in years, the path of opportunity is expanding beyond America's borders in a way that institutions cannot ignore. The difference between institutional investors and retail investors is timing. Retail reacts to news. Institutions position before the news exists. By the time the media explains a trend, it is already crowded, overpriced, and late. That is why the question is not whether US markets are bad. The real question is where the next decade of growth is coming from and how you position yourself before the shift becomes obvious. The numbers explain everything. In 2025, the US dollar weakened significantly against a basket of global currencies. That matters because when the dollar declines, even strong nominal returns in US assets translate into weaker real purchasing power. At the same time, international equity markets outperformed the United States. Germany's DAX returned over 20%. Japan's Nikkei surged more than 25%. Emerging markets delivered close to 30%. Meanwhile, the S&P 500 returned around 16%. 16% is not a bad year, but when you compare it to the performance abroad, you realize the opportunity cost of staying home was enormous. And here's where international investing becomes even more powerful. When the dollar weakens, foreign investments don't just benefit from asset appreciation, they gain from currency strength as well. You earn returns in two layers, the market return plus the currency tailwind. If you invest in a Japanese stock that rises 10% and the yen strengthens 8% against the dollar, your total return isn't 10%, it's closer to 18%. That's why weak dollar cycles historically create massive international equity opportunities. Many American investors hesitate because they assume international markets are riskier. Emerging markets feel unstable. The headlines always sound chaotic. But over long horizons, the data is clear. Emerging economies have consistently outperformed developed ones because they have what the West increasingly lacks: demographic growth. The United States, Europe, and Japan are aging, birth rates are falling, workforces are shrinking, but countries like India, Indonesia, Vietnam, Brazil, and parts of Africa have young populations expanding into their peak earning and spending years. Young populations drive consumption, productivity, infrastructure growth, and long-term economic expansion. Capital always follows growth. The challenge for most investors is that they don't know which country to pick. Betting everything on one nation is risky. That is why institutions use broad baskets instead of single country gambles. Instead of trying to guess the one winner, they buy broad exposure to the entire developing world. That's why some of the largest capital flows right now are moving into emerging market ETFs that capture this rotation. Funds like Vanguard's emerging markets exposure give investors access to China, India, Taiwan, Brazil, South Korea, and more in one diversified allocation. These markets may be volatile short-term, but institutions accumulate during quiet consolidation periods, not during euphoric breakouts. The biggest money positions early while retail is distracted. Japan is also part of this shift in a way that surprises many Americans. For years, Japan was viewed as a stagnant economy, but Japan has undergone major corporate reforms, improving shareholder returns, increasing buybacks, boosting dividends, and unlocking value that was dormant for decades. A weak yen has also made Japanese exports more competitive globally. Institutions are increasingly bullish on Japan because it offers stability, world-class companies, and a market that is finally focused on profitability. Broad emerging market funds have also been outperforming dramatically. When institutions want to make a macro bet that global growth will outperform US growth, they don't pick one country. They buy the entire developing world and let compounding do the work. The psychology of this moment is critical. Most investors panic during uncertainty. They see geopolitical tension, trade disputes, dramatic headlines, and market pullbacks, and their instinct is to sell and wait for clarity. That instinct destroys wealth. Institutions don't panic, they reposition. Money does not leave the market during volatility. It simply changes hands, moving from emotional investors to disciplined ones. Every major capital rotation feels uncomfortable before it becomes obvious. In 2009, buying US stocks felt terrifying. Institutions bought anyway and made fortunes. In March 2020, buying during the pandemic crash felt insane. Institutions bought and doubled their money. Maximum fear always precedes maximum opportunity, but only for those positioned early. Most investors make the same mistake. They wait for certainty. They want the news to tell them it's safe. But certainty is the most expensive asset in the world. It only appears after the returns are already gone. BlackRock is not waiting for certainty. They are acting on probabilities. And when the largest asset manager on Earth shifts $2 trillion, that is not noise. That is a signal. This doesn't mean abandoning America. It means balance. US sectors like defense, industrials, and strategic resources remain strong, but ignoring a global rotation of this magnitude is the real risk. You don't need to predict the future, you just need to follow the footprints of institutional capital. There's also another major shift tied into this rotation: gold. Under new banking regulations, gold has been reclassified as a Tier 1 liquid asset, meaning banks can treat physical gold as equivalent to cash reserves. That changes everything. Gold is no longer just a hedge or a relic. It is becoming operational collateral inside the global financial system. That is why institutions have been accumulating it aggressively, pushing prices to historic highs. This isn't just fear, it's structural demand. The bottom line is simple. BlackRock just moved $2 trillion. The question is whether you notice the shift early enough to position with institutions, or whether you stay trapped in yesterday's winners while the next decade of growth is building somewhere else. The rotation is already happening. The only thing left is whether you move with it or wake up after the opportunity is gone.